Welcome to the 14th Annual Griswold Center for Economic Policy Studies Senior Thesis Research Forum. Thank you all for tuning in to this event. The purpose of the forum is to showcase outstanding economic policy-related research produced by our matriculating seniors in the Department of Economics at Princeton. We would like to thank the selected students for their hard work preparing their presentations and to congratulate them on winning the 2025 Griswold Center Senior Thesis Prize. This year's presenters include Amelia Feiner. Amelia's thesis explores the effect of mandated infertility treatment coverage on female labor outcomes. Amelia's thesis advisor is Nancy Reichman. Angeli Brunemeyer. Angeli's thesis investigates the local labor market trade-offs of recent U.S. power plant retirements and renewable energy expansion. Angeli's thesis advisor is Nancy Reichman. John Barrett. John's thesis analyzes how managerial environment impacted performance during the implementation of Japanese corporate governance reforms. John's thesis advisor is Jin Liu. Rishi Gorrepati. Rishi's thesis focuses on public transit and employment rates in Northern Virginia. Rishi's thesis advisor is Sofie Grouws. And of Grouws. Sofie's thesis researches rural economic stagnation despite farm recovery in the long aftermath of the 1980s U.S. farm debt crisis. Sofie's thesis advisor is Motohiro Yogo. Thank you again for tuning in for this virtual forum and for your support of undergraduate research.
Hi, I'm John Barrett, a recent grad of Princeton University within the Econ department, and today I'll be talking about my senior thesis on Japanese corporate governance reforms in the mid-2010s. To provide a little bit of context, in the 1990s, Japan entered the lost decade, and a few structural issues emerged. One was zombie firms, in which unproductive firms with a significant amount of debt continue to exist because of zero interest rate or negative interest rate policies that were implemented within Japan. Managerial entrenchment was linked to this practice known as kiritsu, or cross holdings of a firm's suppliers, bank, friends and family, and created basically this web of protection from any external shareholders. So that way the management could continue to exist and not be fired from the actions of a third-party shareholder. Short-termism was management really focusing on the quarterly performance rather than long-term growth initiatives or investments. And as a result, it caused both the firms and the economy to really stagnate. In order to resolve this, Shinzo Abe proposed the three-arrow initiative, the first being monetary policy, the second being fiscal policy, and the third, which is the main focus of my paper, being structural changes. And there are a few elements related to the structural changes, but the main area that I focused on within my paper was corporate governance reforms. And the three prominent reforms that I looked at were the Stewardship Code in 2014, the Corporate Governance Code in 2015, and the Fair M&A Guidelines in 2019. And I'll be pretty brief in terms of what exactly these reforms did, but basically the Stewardship Code created a framework and suggestions for how investors interact with firms and really allow for a improvement within the shareholder focused environment. Corporate governance code similarly had firms interact with investors, and once again trying to shift away from the stakeholders and management to the shareholders and how to better the dynamics between the investor and firm. And then third was the Fair M&A Guidelines, which created a framework for how M&A transactions should ensue and basically hoped to allow for quicker transaction times, hopefully lower costs, and just a general best practice across the economy. In order to understand the potential impacts of these three reforms, I broke the literature review into three parts, or four parts rather. The first being the quiet life hypothesis. And this was coined by Ikeda et al. In 2018. And this paper focused on how when these managers are protected through a significant amount of cross holdings, they're no longer concerned about providing value for shareholders, but rather are far more self-interested and protect themselves to continue their legacy within the firm and provide for their family. And then this was kind of a core focus on how a lot of these structural issues came about. And so then I continued my literature analysis on the shareholder participation, which is a lot more linked to the stewardship code and the corporate governance code. And from here, I found in general a very positive impact on firm productivity and performance when shareholders had improved shareholder rights and there was a significant presence of shareholders there. The third bucket that I looked at was M&A impact. And Fukuda in 2020 basically labeled three different theories on the potential impacts of an M&A transaction. The first being the value creation, in which both the acquirer and the target benefited. Second being value transfer, in which either one of the parties actually benefited. And then third was the zombie theory, which neither of the parties actually benefited from. So this was helpful context when looking at the fair M&A guidelines and seeing whether or not they created changes within this actual firms themselves. The fourth bucket was the corporate governance reforms and what the literature says about it. And I broke it down into two sections. The first being a broad global context, and the second being Japanese specific. Interestingly, within the broad global context, corporate governance and the reforms associated to them were very beneficial to firms. However, within the Japanese context, it was a lot more nuanced and not a universal benefit to firms itself. So this was very critical to understand when actually analyzing the results from my study. And so briefly getting into the data and methodology, I used a panel event study utilizing Clark 2022 and Sun and Abraham 2021's design. And I broke the control and treated it into two groups utilizing strategic ownership percentage. And so this was linking back to the Keiretsu, in which higher strategic ownership means higher cross holdings, which is more likely to have managerial entrenchment and other of the systematic issues caused by higher cross holdings. And I found that above and below the 25th percentile had the most statistically significant results, in which below the 25th percentile, we saw significant benefits within the firms themselves, which suggests low cross-holding is a more favorable environment. Getting into the controls a little bit, I used very standard controls like linear time effects, firm fixed effects, such as I also utilized some other controls such as assets and employee size to basically control all the variables within the firm. And then finally getting into the dependent variables, which is how I linked to the structural issues. So cash to assets was a proxy for short-termism. And so if there was a decrease in cash to assets, this means that the management was potentially utilizing this cash towards long-term growth initiatives and investments. For debt to assets, this was linked to the zombie firms, in which if there was a decrease in debt relative to the assets, that was beneficial for the firms of offloading their debt. Return on assets was a proxy for performance, and then gross margins was a proxy for profitability, and seeing whether or not after these reforms, if the underlying data set saw an improvement within their performance and productivity. So getting into the results, I created a table here breaking down between the three different reforms: the stewardship code in the first column, corporate governance code in the second column, and the fair eminent guidelines in the third column for each of the dependent variables. Starting with the stewardship code, we saw a decrease in cash assets in a temporary time frame, and so this showed that short-termism reduced. Although because of the low strategic ownership and low cross holdings, the temporary sign was actually maybe a signal that the firms were already utilizing their cash pretty effectively. For debt to assets, this reduced and was a permanent trend here, which is very positive for reducing the structural issue of zombie firms. And then we also saw a increase in return to assets following the decrease in cash assets and the decrease in return to assets. And so this showed that management itself was reacting to the stewardship code and actually focusing on providing performance and benefiting the shareholders themselves. Moving over to the corporate governance code, we actually saw no impact in the cash to assets and a continued trend within debt to assets and return to assets, which makes a lot of sense because both of these were focused on investors and how they interacted with firms and vice versa. But interestingly, within the gross margins, this actually started to improve. And so it seems like there was some kind of relationship between debt to assets, return to assets, improving, and then finally profitability comes about. Interestingly, within fair M&A guidelines, there's actually no impacts, which is aligned with Fukuda 2020's zombie theory conclusion. So based off these results, the three implications for my study that I had were: first, pressure or punitive actions is critical. This was based off something called the comply or explain framework, which I didn't mention earlier, but firms needed to adhere to both the stewardship code and the corporate governance code or explain why they weren't adhering to it. So this created some external pressure by, either the government, the regulators, or shareholders. And the fair M&A guidelines did not have this. And so this dichotomy itself actually presents a meaningful conclusion from the study itself. Second was the elimination of cross holdings. As we saw, there was a positive impact within the low cross holding treated group. And this should be a key focus of policymakers: eliminate a lot of the structural issues attached to high cross holding environment. And so then they could, have management be more run effectively and focus on shareholders. Finally, bolstering shareholder rights, participation, and institutional investor presence is critical. This allows for the shareholders to actually interact with the firms, provide suggestions, allow for growth to occur, and let the market dynamics take hold of the economy. I hope you enjoyed. This was a lot, and feel free to reach out to me if you have any more questions, but that is my paper on reforming the reforms, an analysis on the Japanese corporate governance reforms. And thank you very much for listening. Have a good one.
Hi, my name is Amelia Feiner, and today I will be presenting on my senior thesis research, which is titled The Power of the Payer, where I studied the effect of mandated infertility treatment coverage on female labor outcomes. So just a little bit of background on my topic. I studied a series of policies that were passed at the state level between 1987 and 1995. And because these policies were passed at the state level, that means that they were not all identical. They weren't rolled out in a sort of uniform way. And so, although broadly the policies acted to do the same thing, which is lower the barrier to infertility treatment by reducing the cost. They varied along several axes, as you can see here that I plotted out. So some of the policies were mandates to cover and some were mandates to offer, which means that some mandated that all insurance policies cover these, and while others just mandated that all insurance companies offered a package or an insurance policy that did cover them. Similarly, the policies varied by type of coverage mandated. So some mandated IVF, which is in vitro fertilization, the most expensive kind of infertility treatment, while others were for non-assisted reproductive technologies. And finally, the target groups of these policies varied. So depending on the type of health insurance that you had, the mandates would apply to you differently in different states. So part of the puzzle and part of the fun of my senior thesis project was kind of getting to pick apart these heterogeneous policies and dig into exactly which provisions in the policy were driving the changes that I saw. So first of all, there were two big papers that were driving most of my work here. So Lucy Schmidt, working out of Williams College, found that the presence of a state mandate had this really strong effect for first birth rates for white women over the age of 35. And so I thought that shift would kind of have changes for the labor market too. And then we also see kind of downstream of that, women in treated states, so states with mandates, showed an almost 1% increase in likelihood of completing a professional degree. So these were kind of my two guiding papers, both for methodology as well as for providing initial evidence that maybe I would find something here for labor. So my broad research question is here, and what I wanted to answer was, how does increasing financial access to infertility treatments impact female labor market outcomes? And when I was thinking about why this might affect labor, there were kind of two main causal mechanisms that I was considering. So on the first hand, higher first birth rates in a cohort should reduce both labor force participation, because as demonstrated in tons of literature, when women have more kids, especially on the extensive level, so a woman who goes from not having a child to a woman who goes to having one, as opposed to intensive, which is an additional child, that has really significant deleterious effects on women's labor force participation and also their lifetime earnings. But there's this second kind of causal mechanism where that's been established by a lot of the literature on contraceptive access, that postponing childbirth has this inverse positive effect on women's labor outcomes. So there's this kind of virtuous cycle where women can postpone childbirth and have then stay in school for longer, which increases their labor force attachment and mitigates kind of the motherhood penalty. And you get these actual returns then to lifetime earnings and some of the negative labor market effects of motherhood, just broadly speaking. And so with these two kind of separate and counteracting causal mechanisms in mind, I went to collect my data. I basically used very simple census data I sourced from ASEC. I focused my main sample on women between the ages of 35 and 50, because those are the women who are more likely to use infertility treatments. But then I included a group of younger women that, as you'll see with my methodology down the line, I was able to include as a kind of secondary control group in addition to women in untreated states. So the variables that I looked at were the age of youngest child for my, repeated cross-section of data, because that'll give me some information about the age at which the women are having children, labor force participation, and then the average income of women who do remain in the labor force. And as in many a state policy paper, I was able to use a staggered dynamic difference in difference model. So I looked at the relative changes in female labor outcomes between treated and untreated states. And then I was able to do much better robustness checks because of the kind of age cohort nature of the policy. So I was able to use the differential in infertility treatment utilization between young women and older women to ensure that these trends are actually because of the policy and not because of some other confounding change that's happening to all women in the treated states. So my results for labor force participation are shown on this page. So I ran a dynamic model, so I looked at all of the years like an event study. And I saw that there is kind of a straight trend, and then you see a slight decrease, as you can see in this graph on the right, that starts about 4 years after the policy is enacted, which makes a lot of sense because it takes some time for women to adjust their decisions. Career and fertility planning are things that you can't kind of immediately change your behavior in response to a policy. And in my static model, I found a statistically significant, about 0.8% mandate associated decrease in the probability of labor force participation. And for income, interestingly, I found the opposite. So I found that there are actually modest returns to delayed fertility for women who choose to stay in the labor force. So mind you, this excludes, let's say, a woman who delayed birth and then chose to have a child above the age of 35 and dropped out of the labor force. But for those who do stay in, we see an about $1,000 mandate associated increase in yearly income. And I was able to check both the labor force outcomes and the income outcomes with triple difference robustness checks that I was talking about before. And the labor force participation was robust, and income is a bit of a finicky outcome variable just because of the way it is skewed, and you can take the natural log of it and look at percentage changes, but there was a lot of confounding, I think, in the income results for my triple difference results, but they were significant for the static difference in difference, and also you can see the trend happening in the dynamic difference in difference in the figure on the right-hand side of the graph. And, this was a very interesting year to be working on a project that had to do with a policy that some would consider to be pronatalist, especially in political discourse with the Trump administration, and also kind of throughout the developed world. There's been a lot of emphasis on pronatalism and policies that promote higher fertility rates. The big beautiful bill just actually raised the child tax credit. And it's interesting to think about my thesis in relation to some of those broader current events, because there is this trade-off, it seems, in policy and also in the economic literature between women's education, women's labor force attachment, and also fertility. And actually, Project 2025, the policy agenda by the Heritage Foundation that came out last year, proposed defunding higher education in order to increase the birth rate because less educated women tend to have more children. And, I think there is some danger in thinking about these things as a trade-off. But, even though my policy or my policy analysis it's impossible to take my policy analysis outside of the context of some of these broader ethical questions that we're asking in society today. So it was a very interesting year to work on this project. Thank you so much.
Hi, my name is Rishi Gorrepati, and I'm super excited to talk about my thesis today. My thesis was titled Public Transit and Employment Rates in Northern Virginia, and I was advised by Professor Nicholas Buckles. So first I'll do a little intro. There's a lot of literature and existing research that has a pretty wide consensus that the development of public transit is especially helpful in job poor areas. So those are areas with low employment rates and areas that don't have too many local jobs. Effectively, the development of new public transit is able to connect people looking for jobs, so job seekers, with the locations of where these jobs actually are, and that improves local labor outcomes. However, there isn't that much research on whether the development of public transit is still beneficial for these same local labor outcomes in areas that have super high employment rates and an excess of pre-existing local job opportunities. So, in essence, this thesis investigates is public transit still beneficial for local communities and their labor outcomes if there are already more than enough local jobs? Yeah, Northern Virginia is a pretty wide region. So in particular, I'm focusing on the Tysons and Restons areas. Despite a lack of planned public transit development and being super close to Washington, D.C., this area would become an independent car-centric, which is key, and a bustling hub of commerce on its own. It's been the largest edge city in the United States since the 1980s. Furthermore, it has a really high median household income of $130,000 per year, and it even receives a significant number of reverse commuters from DC, which means that people are coming from DC, living there, and then, working in this area. In 2014, the Silver Line Phase 1 stations opened as part of the Washington, D.C. metro network. And because of that, or unclear if it's because of that, but around that time, right, Capital One, Hilton, and a lot of other big Fortune 500 companies would establish their headquarters in Tysons. However, it's unclear whether that growth actually benefited locals due to the pre-existing high levels of employment and job access before 2014, so before these new train stations opened. So these are the three data sets that I used throughout my thesis. The first is a Washington Metropolitan Area Transit Authority's Metro Stations Regional Database. Kind of a mouthful, but that basically just gives you the locations of each of those stars on the map on the left. So the red stars are the new stations, the Silver Line Phase 1 stations, and the black ones are the pre-existing stations, which were there before 2014. My second data set was the U.S. Census Bureau's Shapefiles database, which kind of gives you, each of those blocks you see on the map on the left. It gives you the shape of each of those blocks, and kind of their location, which is super helpful for mapping software and GIS software. The third data set was the American Community Survey, which provides demographic data like employment, labor, and other characteristics for each of those block groups. So by connecting these three data sets, you're able to kind of figure out, okay, what about this block and what type of people live in this block? How are they doing? What's their employment rate? And furthermore, what's their distance from the station? So you can kind of understand, like spatially, how each of these stars, each of these stations affects the local surroundings. And I use three methodologies. The first is spatial regression, which I use to understand distance decay effects. So, which is essentially the further you get away from something, so the greater the distance, how much does that affect decay, which is super helpful in terms of understanding how much does the effect of that new station that was opened decay over distance. The second was a nearest neighbor difference in difference model. So that's effectively for each of these new stations, let's compare it to a place that didn't have a new station open, and let's see how much change there was in this new station, which kind of helped us visualize individual effects for each of the blocks around the new stations. And a third method was a synthetic control difference in difference. So broadly, rather than each block being compared to its own block, let's just all compare them to the same block. So then we can understand, okay, the new station opened here, and how much did each block surrounding that station change relative to each other, right? So for example, did north of the station change by 100%, while south changed by 50% and stuff like that. So now I'll walk through the first methodology, the spatial regression methodology, as a robustness check for the underlying intuition regarding both Tyson's is an employment hub, we would expect to see a decrease in labor market efficiency over distance, which means that we want to find an inverse relationship between distance from Tyson's and employment rates. So we ran a spatial autoregressive year fixed effects model to estimate the average employment rate from before to after 2014. So before and after the station's open, at zero distance from the station centroid, right, as a good estimate. So that's that like dark reddish colored pin right in the center of that circle on the map on the right side. And then we want to see the linear distance decay effect after station open. So the further it gets away from the pin, how much does this effect change? So we were able to find that, there's a highly statistically significant coefficient on the post variable, and it showed that at that zero distance, at that red pin, it was associated with a 3.16 percentage point increase in employment rate. Furthermore, it shows that the further you get away at a moderately statistically significant coefficient on the distance x post variable, for each additional mile from that center, there's a 0.723 percentage point decrease in employment rate. However, one major caveat with these spatial autoregressive models is that there are endogeneity issues arising from the inherently endogenous spatial lag term. Next up, I'd like to talk about my nearest neighbor matching methodology. Effectively, on the left-hand side, you can see a whole bunch of red circles and a whole bunch of blue circles. Each of those red circles and blue circles are a 1 mile buffer from a train station. The red circles are a 1 mile buffer from the new Phase 1 Silver Line stations, while the blue ones are a 1 mile buffer from the old ones. And because we're trying to find a similar block for each of those blocks within the red circles, so we can't have another area that already has a train station, right? We can't compare how much does opening a train station affect employment rates for those red blocks in an area that already has a train station. No, we need to find an area that doesn't have a train station, but is also somewhat close. So the map on the right is all the potential control blocks, which is effectively just every single block in the area minus all those blocks on the left-hand map. And it came out with 35 pairs. So the difference model was able to be used on these 35 pairs, both at the individual levels, which is 35 separate regressions for each of those pairs. So for example, you can see a pair on the bottom, right? So you can see that the median rent is exactly the same, and the household income and employment rates are both very similar and both very high. And then you can see that their locations on the right-hand side in that map, and you can see that they are, somewhat nearby each other. And then furthermore, by doing that, you can see the individual effect of, okay, how much did this specific block change? However, this was also able to be one regression done at an aggregate level, right? So how much did all of the treatments change compared to all of the controls, which kind of gives you an average causal effect. And yeah, you can see here is the average causal effect, the aggregates. So it's the aggregate of all the treatment groups on the top and the aggregate of all the control groups on the bottom, the summary statistics. So you can see that they are pretty similar. And on the right-hand side is a map of all 35 pairs. And, there are some that are a little bit further away, like the blue block on the far right. But, at some point I had to sacrifice distance, and the algorithm had to sacrifice distance to get something that was more similar to the block. Yeah. And so now here are the results. So you can see on the left is the results for each of the individual pairings, and then the table is the result for the aggregate regression. The individual pairing showed that there were 12 groups with positive employment change, 8 groups with negative, and 15 with statistically insignificant. So those are the grays. There's not really like an evident spatial pattern, but the aggregate showed that each block within a mile of the new Silver Line station had a 1.39 percentage point increase in its employment rate compared to its paired control group. And then our final methodology was a synthetic control methodology, which, the rationale for this is that because each one we were comparing to a specific block, we aren't really able to compare how much did each block change compared to its neighbor, for example. So by giving them all a similar basis, giving them all one universal control block, which is our synthetic control, we can understand the relative effects of one block compared to another in kind of in consideration of the new station that's opening. And you can see below is the table that has the summary statistics of that synthetic control group. And here are the results. On the left-hand side, you can see that there are 13 groups with positive change, 12 with negative, and 10 with statistically insignificant results. And once again, there isn't really a super strong spatial pattern effect, at least that I can see, And on the top, you can see the aggregate results, which show that each block within a mile of the newly opened stations had a 1.5 percentage point increase in its employment rate compared to the overall synthetic control group. And here are my key results. So the spatial regressions, as before, there was a 0.35 percentage point per mile from the stations. That was the distance decay. And then that was just pre-treatment, so before 2014. And then after 2014, that distance decay effect nearly doubled to 0.72 percentage points per mile, which is interesting to note. But it kind of makes sense, right? As a development of a station would naturally have a more concentrated employment effect in comparison to the pre-existing concentration, which may be a little more spread out. And maybe this is partially due to clustering, especially because a lot of the businesses that are coming in, like Capital One, like I said earlier, there's a lot of tech and finance companies. These are all knowledge-based businesses, which really exhibit clustering behavior. And then for 1C, there's an overall 3.16 percentage point increase in employment rate associated with the station opening, given a hypothetical zero distance, which was right in the center. Off of the paired aggregates, you can see that there is about a 1.4 percentage point increase in local employment rates associated with the openings. And with the synthetic control, you can see there's about a 1.5 percentage point increase in the aggregate. And although these don't seem like a lot, it's important to remember that this local treatment area is already at a super high employment rate of 93.4%. So even these small percentage point increases are pretty substantial. And the individual paired and synthetic regressions, they provide pretty mixed and incomplete results, as you saw in the maps earlier, with more than 25% of the blocks in both regressions having statistically insignificant results. And the policy implications. So, they build on existing literature's consensus of public transit development having a positive effect on employment rates. But this builds upon that by saying that even if an area already has a very high employment rate, like Tyson's and Reston's, and a surplus level of pre-existing jobs, like Tyson's and Reston's, public transit development can still be super effective in improving local employment rates.
Hello, my name is Sofie Grouws, and I'm excited to share with you today my thesis, which is entitled Rural Economic Stagnation Despite Farm Recovery in the Long Aftermath of the 1980s U.S. Farm Debt Crisis. I was advised for my thesis by Professor Motohiro Yogo. My thesis was driven by three main research questions, which were the following. First, what were the long-term economic effects of the farm debt crisis of the 1980s in rural America? What role did local credit supply play in generating long-run crisis impacts? And finally, how did the policy response to the crisis alter local credit supply and ultimately shape the long-term impacts of the crisis? To give you a brief summary of my findings before we get into the weeds, in my thesis, I found that the farm debt crisis has had a persistent negative impact on both incomes and populations in rural economies in America that has lasted through 2023. Thus, the crisis is an important driver of the economic stagnation and demographic decline in rural America that began in the 1980s and continues to present day. These long-run impacts were seen to be driven by persistent supply-side tightening of credit at local community banks. Additionally, I found significant differences in recovery in the farm and non-farm sectors of the rural economy. In particular, farm sectors had recovered by 2000 relative to those that were in less affected areas. Meanwhile, the non-farm sectors of more crisis-impacted areas have yet to recover and remain depressed to this day. I found that these differences in sectoral recovery appear to be driven by differential credit tightening between sectors, which was motivated in part by policy incentives. So how did I get to this question? Well, I was interested in this picture of rural economic decline that we've seen since the 1980s. We've seen rural economic stagnation since the 1980s, characterized by lower wage growth and lower cost of living adjusted incomes in rural areas relative to urban areas, along with persistently higher rates of rural poverty. This has gone along with demographic decline, including population loss, which has triggered the loss of schools, hospitals, and businesses from rural areas, loss which is selective of more educated, younger individuals. And this decline in rural economies has coincided with a booming farm sector, which runs contrary to popular wisdom about the relationship between the health of the farm sector and the broader rural economy. This brought me to the unstudied impacts of the farm debt crisis as a potential driver of this stagnation. To combat this rural economic decline, we need an understanding of its causes. And the farm debt crisis of the 1980s stands out as an unstudied potential driver or trigger of this decline. The crisis, which ran from 1981 to 1987, was a major boom-bust cycle in agricultural commodities, triggering a mass default on agricultural loans in the US. The crisis was notable for its size and its impacts on the rural financial sector, which differentiates it from a standard boom-bust cycle in agriculture, which we expect to have transitory effects. Overall, the crisis had devastating immediate impacts on rural economies and financial institutions. But despite these devastating immediate effects and the contemporary turnaround of the contemporary beginning of this rural decline, there are no studies on the long-run economic impacts of this crisis. This is in part due to a lack of scholarly interest in the subject, and also due to challenges in the identification of crisis effects in the long run. I'll briefly perform a literature review, giving you a couple of highlights. A first section of the literature I looked at is the literature on the impacts of the farm debt crisis. I found many descriptive short-term studies that suggest important immediate effects, and some popular media and books that have recounted longer-run effects, but as I mentioned, no long-term rigorous statistical studies of the effects of the crisis. I also looked at the literature on the role of credit in generating real impacts of financial stress. Jorda et al. Provides cross-country evidence for the role of credit cycles in generating economic impacts of financial crises, and Bernanke and Greenstone et al. Come to very interesting different conclusions about the role of credit disruptions on the real effects of financial crises and recovery dynamics. Overall, my literature review led me to believe that there is a need for a rigorous study of the long-term impacts of the farm debt crisis, and that there's evidence to suggest that credit supply may play an important role in generating the impacts that I may find. I'll now do a quick rundown of what happened during the farm debt crisis, as I'm sure many of you are unfamiliar with it, as I was before doing this project. The crisis can be divided up into four main phases. The first is the run-up between 1970 and 1981. This was a massive boom-bust cycle in agricultural commodity prices, which saw real farm income in the US nearly double from $48.4 billion to $92.1 billion between 1970 and 1973 alone. The real value of farmland increased 92% from 1969 to 1981. These increases fueled a sharp rise in farm debt, which was largely backed by farmland collateral. Farm debt rose from $29 billion to $71 billion between 1970 and 1979 in the US, creating a leverage-fueled farmland price bubble, which those familiar with the GFC know is a recipe for a potentially painful crash. Our second phase of the crisis is the farm-centered crisis, which ran from 1981 to 1983. At this point, farm commodities bust due to falling demand for commodities, an overvalued dollar, and aggressive monetary policy by the Fed. This generates a severe downturn in the farm sector in both absolute and relative terms, with significant geographic variation based on the local commodity mix, which determines how exposed each locale was to the falling commodity prices. However, at this phase, we see little contagion to the broader rural economy, which changes in our third phase, the rural financial crisis from 1984 to 1987. Here, the downturn in the farm sector begins to generate significant local financial stress as farms' equity buffer gets drawn down, and we see a spike in non-performing loans and commercial bank failures. This financial stress spills over to the broader rural economy. During this time, there's a contentious policy debate about whether or how to respond. Eventually, the government decides to respond, but with a very narrow focus on the farm sector. A key policy in this response was a shift from direct to guaranteed loans through the FCS Farm Loan Program, which we'll discuss in detail later. Finally, the post-crisis phase from 1988 to present. The crisis, by most accounts, ends in 1987 when commodity prices normalize and farm incomes start to recover. But as we will see, the impacts of the crisis do not end in 1987. Getting to my methodology. The goal of my paper is to estimate a relationship between local crisis intensity and county-level economic outcomes of interest, which can be seen with this simple regression, regressing local economic outcomes on crisis intensity along with a variety of controls. Local crisis intensity is measured by the initial farm income shock in a county between 1974 and the 1982 bust. However, there's an identification issue here. There could be simultaneity of local crisis intensity and local economic outcomes. For instance, it would be reasonable that, say, an area with other economic problems might also be subject to more farm income drop. So to solve this, we need to find an exogenous instrument for crisis intensity. To do this, I create a shift share instrument and then use a two-stage least squares regression to estimate my regressions. A shift share instrument is a two-piece instrument that consists of a share and a shift. The share, in my case, is the percentage of market agricultural value for each given commodity in a county. So this measures the exposure of a county to price changes in each commodity. The shift, in my case, is the growth and producer price index of agricultural commodities between boom and bust, which creates a common exogenous shock that is constant across counties. The idea of the instrument is that the share determines the differential exposure of a county to a common exogenous shock. Following Goldsmith and Pinkham et al., I use the strict exogeneity of shares to prove the validity of my instrument. Overall, my identification boils down to the claim, which I defend more rigorously in the paper, that local commodity mix does not generate differential changes in economic outcomes except through exposure to commodity price changes conditional on controls. Using this shift share instrument brings me to this two-stage least squares regression model, which I use for all the analysis in my paper. Essentially, in the first stage, I regress my crisis intensity measure on my shift share instrument, and then use that predicted crisis intensity as the dependent variable, as the variable in my second stage regression with my outcomes. Because I'm just using a single instrument, these two stages can be simplified to this one reduced form where I directly put my shift share instrument into my second stage equation. I use a lot of varieties of data sources for this paper. My overall period of analysis runs from either 1981 to 2010 or 2023, depending on the data source. I focus most of my analysis on the non-metropolitan counties, which leaves me with 2,443 counties, which I classify using the USDA Rural Urban Continuum codes. I use the Economic Research Service of the USDA's county typology codes to determine an ag-dependent county. My agricultural data, including my commodity shares for each county, comes from the USDA Census of Agriculture. I look at a range of outcomes of interest, including population, employment, personal income, and proprietorship, farm and non-farm, which come from the BEA regional economic accounts and the Census county business patterns. My bank lending data comes from call reports, and I restrict to community banks. And finally, the data on the FSA Guaranteed Loan Program comes from the Iowa FSA. Using this data, I construct my instrument. The histogram on the left shows the distribution of the standardized commodity shock, so the distribution of the standardized instrument, to give you a picture of how different counties, basically the range of intensities across counties of this shock. And as you can see on the right, there's significant geographic variation in intensities. Using this instrument, I conduct all of my regressions using the model specified above. I'll first discuss the overall rural economic outcomes that I find. I find that income levels and growth are significantly, economically and statistically, and persistently reduced. So between 1981 and 2023, a county experiencing a one standard deviation more severe local crisis sees reduced personal income level by approximately 5.6%. Overall, differences in local crisis intensities can explain differences in annual personal income levels of over 22% between 1981 and 2023. Population size and growth are similarly reduced. In both cases, the negative effects grow over time, with the strongest effects occurring between 2010 and 2023. Additionally, I do some heterogeneous analysis and find that effects are stronger in counties that are agriculturally dependent. I then break things down by sectoral differences. So I look at the overall picture of the farm sector is that it suffers during the crisis, but it does recover. So during the crisis, counties that experience a one standard deviation worse crisis have approximately 12.3% lower farm incomes annually. But by 2000 to 2010, farm incomes in more and less affected counties are virtually indistinguishable. My analysis of income growth shows that farm incomes in more affected counties grew significantly faster after the crisis, leading to this farm recovery. Farm proprietor incomes show a similar trend, and overall evidence supports a transition in the farm sector in more impacted areas. through number of establishments, average size, frequency of family farms, labor and expenditure changes. The non-farm sector is a different story, however. Overall, the non-farm sector does not recover and remains depressed through 2023. Between 2000 and 2010, when the farm incomes have completely recovered, non-farm incomes remain 7.4% lower annually for each 1 standard deviation more severe shock. Results are similar for non-farm income growth and proprietorship income. And overall, we see significant long-term reductions in non-farm employment and proprietorship in more crisis-impacted rural economies. Given these results, I then begin to investigate the mechanism, which I look at as the role of the bank credit supply. So my potential mechanism is that local credit market disruptions persist after the crisis and reduce economic activity and opportunity, leading to these longer-term effects. I do find that community bank lending contracts in more impacted areas. In particular, community bank loan volumes in more shocked areas are 8.1% lower for each 1 standard deviation more severe shock, annually 1981 to 2000. I also modify my instrumental variable to be an interaction between the shift share crisis intensity measure and the pre-crisis bank exposure to agricultural loans in order to instrument for loan growth post-crisis, which suggests that lending contractions are mainly driven by supply rather than demand-side disruptions in credit. Finally, regressing income growth on predicted loan growth based on crisis intensity supports the claim that bank credit contraction on the supply side is an important determinant of recovery or lack thereof. I also attempt to explain sectoral recovery differences through changes in sectoral lending. To do this, I analyze changes in the levels and shares of agricultural lending and C&I lending at community banks, which overall suggests that credit was differentially tightened by sector after the crisis. In particular, agricultural credit actually expanded in more affected locales, while commercial and industrial lending contracted. This shift in portfolio distribution between agricultural and non-agricultural loans suggests that the sectoral differences observed in the credit supply could explain the observed recovery dynamics between the farm and non-farm sectors. Finally, I look at the role of government policy in driving these changes. In particular, I want to understand why banks in areas that are more affected by the farm debt crisis would actually increase their agricultural lending portfolio post-crisis. The answer? Potentially government policy incentives. This brings us back to the guaranteed loan program that I mentioned earlier. Through the guaranteed loan program, community banks could sell 95% of farm loans to the government for a participation fee, which would significantly reduce the risk of agricultural lending relative to non-agricultural lending. Overall, banks that are more stressed and have lower risk appetites as a result may find this program more attractive, be more willing to pay the fee to participate, and thus shift their lending towards the agricultural sector despite their stress. Overall, evidence from the Iowa FSA program suggests that this may have been the case, with program participation driving changes in lending portfolios and local stress determining program participation, suggesting that government policy may have played an important role in determining sectoral differences in recovery from the farm debt crisis. So what does this all tell us? Overall, I found that the farm debt crisis has had long-lasting negative effects on rural economies in the U.S., particularly in the non-farm sector. This significantly contributes to an explanation of the puzzle of rural economic and demographic decline post-1980, despite a flourishing farm sector. I also find that local credit supply shocks and changes in credit distribution are important determinants of the nature and presence of recovery from financial crises. This brings us to the policy lessons that I draw from my work. Overall, I think the key lessons are the importance of maintaining local credit supply throughout financial crises to avoid similar long-lasting scarring of rural economies and other economies. The need for careful consideration of the incentive structure and potential crowd-out effects generated by credit market interventions. And finally, from a more broad perspective, the need for policy that supports the rural economy as a whole, rather than a narrow focus on the health of the farm sector. Thank you so much for listening. I hope you enjoyed. Thank you.